Hi group, it's Mrs. Schaus here. We're ready to take a look at gross pay to net pay. In other words, we want to talk about different types of withholdings. There are a variety of types of withholdings. Some of them are required by law, but others are just voluntary. You decide what you're going to have withheld from your pay. Some examples of those that would typically be withheld because they're required to be are federal income tax, state income tax, sometimes local or city tax depending on the location, and then also these two pieces, Medicare and Social Security, which we sometimes call FICA. And depending on how your employer will record the different deductions, sometimes one of these will say FICA beside them, but it's the collection of the two, Medicare and Social Security, that really make up the FICA piece. All right, here are some examples of voluntary deductions. Sometimes folks will have amounts withheld for some savings for retirement. Those might be in accounts like a 401k or an IRA, which stands for Individual Retirement Account. But there are a variety of other savings plans as well. Folks may have money tucked away for health savings accounts or flexible spending accounts. For some charitable giving, perhaps like to the United Way, for an example. It could be for union dues or for a variety of other reasons. Now, don't worry if these things are not items that are familiar to you. We will certainly be going back and talking about those at a later point. But for this particular lesson, we are going to talk about just federal and state withholdings only. You'll need to reference your textbook for this lesson. In particular, pages 788 to 791 give some federal income tax pages to reference. There are charts there. Now, I do want to state that because we're being consistent with what's in our textbook, we are going to use these tables. But in this day and age, your employer very likely would not necessarily use tables, but would have access to the information in something similar to this type of table, but through some type of software or site that they visit, okay? Federal income tax is based on your marital status, the number of allowances that you claim, and also your gross income. So you'll see that as we look at these tables, those pieces of information will come into play. I have some examples for us to take a look at, but before we do that, let me move over here a little piece of what one of these tables looks like, and I'm going to try to come down even further here with the camera so that we get a little better view. But of course, you folks should have your textbooks out, so you should be looking at this same page, 788. First of all, at the top of the table, it does say single. And keep in mind that if you were to turn the page, you'd see a married person's similar table. It is for weekly payroll. So if you're paid biweekly, these figures could be doubled. If we're paid in some other fashion, perhaps there would be a different table that your employer would use. But this is, again, what we're going to use to be consistent with what is presented in our textbook. Now, in addition to the marital status, there are two other pieces. Along the top, each of these particular columns are representing the number of withholding allowances that we claim. That means essentially like the number of individuals that we support. So if you are living with mom and dad and they support you and claim you for tax purposes, perhaps you claim 0. Or if you're a single adult who takes care of them, yourself, and you pay your own way sort of in life and you claim yourself for tax purposes, maybe you'd claim 1. Or if we are married and support a spouse or have children that we support, we would certainly move up the number of withholding allowances. And then off to the side here, it's showing our income level. Notice that there are two different columns here along the side. One says you make at least this amount, but the second one says but less than this amount. So let's just take a look at, for example, $150. In this particular row, it says at least $145, but less than $150. The next row says at least $150, but less than $155. So if you made right on the edge exactly the $150, you would be looking at the second row because it says at least $150, but less than $155. So just to be clear on that. If we find across the top here the number of allowances and along the side here the particular piece associated with our income, then you would follow the two to find where they intersect, and that would be the amount of uh, tax withholdings that you would have. It doesn't mean it's the actual amount of tax that you'd have. Your tax liability isn't determined until the end of the year. Into the start of the next year, you'll get your tax forms and sit down with a tax person or fill out your own tax forms to determine your actual tax liability. But this is the amount that would be withheld and sent into the government towards paying that liability. At the end of the year, you may owe more money, or you may get a refund if you've overpaid. Now, do notice that at the start of this table, there are a whole bunch of zeros before we really get down to some other numbers. That is because when you have a very high number of allowances or a very low amount of income, you're not subject to much withholding. Okay, let's take a look at a few examples. So first of all, it says here that Sam is single. She claims one allowance and earns $476.50 per week. What amount will she have withheld for federal income taxes? So again, we're going to be looking at the single table. That's this one. I need to take a peek here. She claims one allowance, so we're going to be looking in this particular column. And again, her income was $476.50. So $476.50. Let me see. I need to move my camera down just a little bit here. $476.50 sets between $470 and $480. So I'm looking at this row, but I'm going to come over again to that one allowance. That's $48. So she will have $48 withheld for the week. Okay, on to the next one here. Olivia is married and claims 4 allowances for her family. This week she earned $520 even. How much was withheld? So first of all, I need to make sure that I go to the page that says married persons. And I know I'm going to be looking for 4 allowances, but I've got to find the row that has $520 as her gross wage. So again, here is the married persons, $520. Be careful, I'm not talking about at least $510 but less than $520, rather at least $520 but less than $530. And then I'm going to read over here is 0, 1, 2, 3, and 4 allowances. So it's $13 that's going to be withheld. Now, do also notice the different wording in the problem. The first problem says, what amount will she have withheld for federal income tax? The next question says, what amount will be withheld for FIT? FIT is just a shortened, it's a representing or abbreviation for federal income tax. So we should be, thinking about questions that are really asking the same thing, but with a slightly different wording to them. The third problem says that James McDonald is single and claims 0 withholdings. Remember, we talked about 0 withholdings could be something that happens if you live with your parents and they technically provide you with your support. If they claim you for tax purposes, perhaps you would file with 0 withholdings. But sometimes folks that are married or even single and supporting themselves, but they will choose to claim less withholdings because they want more to be withheld from their taxes to make sure that they have paid a sufficient amount in. They don't want to have to perhaps owe at the end. All right, so again, we're going back to our single table, and also we know that we are dealing with 0 withholdings, so we'll look in that first column, and I've got to find the row that would represent $378.50. So $378.50 sits between $370 and $380, and again, he was claiming 0, so $42 would be the amount withheld. That's really all there is to the federal withholding pieces. For us is just as considering the person's marital status and then number of allowances along with weekly pay to find the intersection in the table. Not too bad. The next piece on state income tax, well, first of all, it's important for us to note that it is based on our taxable wages and the state income tax rate. Now, taxable wages mean that we take our annual gross pay and we subtract off personal exemptions. Personal exemptions are amounts of money that are not subject to tax. And again, it's really associated with the number of individuals that we support. So we would get a certain amount of money for ourselves that's not subject to tax, a spouse if we are supporting that spouse, um, or filing, together jointly. And then also, again, some amounts for children or others that we support, according to legal tax codes. Okay. Um, Notice that in Michigan, in the state of Michigan, we pay a flat income tax rate of 4.25%. So in Michigan, 4.25% of our taxable wage is how much that we pay or have withheld rather annually. And then again, our actual tax liability would depend on filing our actual tax return. In other states, the flat rate that you pay might be a different percentage, so you do want to read carefully in the problems to see what rate is being considered. And I'm not going to do it because, again, of our current situation. We're, shy of time, but it is true that in some states they have a graduated tax that they pay. So you might pay a certain percentage for the first chunk of money that you make, and then if your income level goes beyond that, you pay a different, perhaps higher rate, and then again, maybe even at some additional level, pay a different rate yet again. Also, there are a few, not many, but a few states that actually have zero income tax. And often folks will say, ooh, maybe I want to move to one of those states. But don't worry, all states have to have a budget and have to be able to fund that budget in some way. So it is often the case that folks that live in those states pay higher in other types of taxes. So perhaps their sales tax, for example, is higher than it is here in the good old state of Michigan. Okay. All right, let's take a look. Clark is a physical therapist assistant. He earns $60,800 annually and is single. The state income tax rate is 4.5% in the state in which he lives. What amount is withheld yearly for state income tax? And once again, you'd have to have some information about personal exemptions. We're going to go with what's in our textbook, of course, but again, from one state to the next, you may have to look up exemptions for that particular state. Our textbook, section 2.2, actually gives us this little piece, which they call a table. I think it looks more like a coin. But at any rate, it says if you're single, you have $2,000 that's exempt. If you're married, $4,000. And for each dependent that you claim to fully support, an additional $2,000. So basically, it amounts to $2,000 for each individual that you'd be supporting. Okay. So again, with Clark, he was single, and it doesn't talk about any other individuals that he supports. So we're going to take his full gross pay, and we're going to subtract off the $2,000 in personal exemptions. Again, not subject to collecting as part of his tax here. So $58,800 is what's subject to his 4.5% tax. 0.045, if we write that as its decimal equivalent, let's see what that is equal to. 58,800 times 0.045 gives me a total of $2,646 that is withheld annually. Now, as you'll see in the last problem, maybe I didn't ask it in the last problem. I was thinking that I asked a question about what if you were, being paid weekly or biweekly or something like that. How would that end up changing? How would we change this essentially to figure out how much was withheld per pay? And maybe we'll talk about that at that last problem. Number 2, Tom Johnson is a counselor. He earns $92,000 annually, and he's married with one dependent child. The state income tax rate is 4.25% in the state in which he lives, just like it is in good old Michigan. What amount is withheld yearly for state income tax? Okay, so I want to take the $92,000 and subtract off $4,000 because he's married, and another $2,000 for the dependent child that he has, and of course, $92,000 minus that $6,000 in total gives me $86,000 that is his taxable wage. I didn't label that here. Maybe you want to label as well. Taxable wage right here once we subtract those personal exemptions. All right, from that point, I'm going to multiply by our tax rate expressed as a decimal, and that gives me $3,655, but again, that's withheld annually. In this last problem, Dave Farner is a cement worker. He earns $56,000 annually and is married with two dependent, this says child, that should say children. Sorry about that, typo. The state income tax is 5% in the state in which he lives. What amount is withheld yearly for state income tax? So once again, we take his $56,000 in gross pay. We're going to subtract off $4,000 for his marital status, monies that's not subject to tax because of supporting himself and his wife, and then $2,000 for each of his dependents. That would be another $4,000 that would get subtracted as well. And of course, if we do $56,000 minus the $8,000, that gives us a total of $48,000 that is taxable wage. And we'll multiply by the tax rate in his state, which is 5%. So times 0.05. That would give me $2,400 withheld annually. Now, if Dave is paid, I'm going to write this down, if paid biweekly. Now we know biweekly means every other week, or in other words, 26 times per year. I would take the $2,400 and divide by 26, and that would give me the amount withheld from each paycheck. So $92.31, if I round to the nearest whole cent, would be withheld per pay. Okay, I hope this gives you guys a little bit of insight into withholdings for federal and state taxes. We're certainly going to continue on with more withholdings at a later point. Try the exercises, submit those into our Google Classroom. Make it a great day, folks, and I'll talk to you soon.